Hello, Money Show audience. I'm Kate Stalter, your video host today here from the Money Show San Francisco, and I am so pleased to be joined today by Catherine Avery of Catherine Avery Investment Management. And Catherine, you have some fantastic tips for looking at asset allocation and some of the different types of investments that are necessary to diversify. So just start out with maybe just sort of the broad definition of what do you mean by that? Because diversification can mean different things to different people.
Right. Well, as you know, Kate, the backbone of our firm is looking at dividend-paying stocks. And oftentimes people think, well, just because you own one type of a stock that you're not diversified. Well, that's not really true, because the way we construct our portfolios is we have a minimum of 30 to 35 names in a portfolio. And we have exposure in each one of the 10 S&P sectors. So what we try to look for are areas that we can underweight, overweight, and maybe equal weight the market versus the S&P 500. But we want to have a piece in each one of those sectors. For example, consumer discretionaries, basic materials, energy, financials, because as the market goes up, we often get that sector rotation, and we never really know when that shift is going to occur. And it's interesting because since 2008, since the financial crisis, as we've gone back and forth as to the economy's growing, the economy's not growing, the interest rates are coming back down, the government is giving us more stimulus, we have found that sometimes in the beginning of the year, the stocks that do well are not necessarily the stocks that do well in the second half.
Right, nor are the ones that are predicted to do well.
Exactly.
Yeah.
So it's really hard to time that. So what we want to do is we want to know that no matter what, we are buying good companies, because we're looking for companies with very strong fundamentals, very strong balance sheets, global brands, big names that pay dividends and have the ability to increase those dividends. So no matter what's happening with the market, we feel secure and have peace of mind that we know that these are good, solid companies to get us through a long-term period of time.
So what's your thinking on remaining invested, say, in a sector that is performing poorly? I know that scares a lot of people.
Yes.
So what's your thinking on that?
Well, you know, you do have to do your fundamental research on the companies. One of those sectors, believe it or not, is the energy sector. Right now, there's a lot of concern that energy prices are going to go down. We have a lot of supply. So what we try and do is maybe we don't own 3 stocks in that sector, but we'll pick maybe 1 or 2 so that we do have some exposure. And again, we apply those same principles. Good balance sheets, good cash flow, and stocks that continue to increase those dividends.
And the reason for that approach being that what you said a minute ago is that you don't know when that sector rotation is going to occur necessarily.
No, you never know when it's going to occur.
Right, so you want exposure to all of these.
Yes.
So another element of the diversification, asset allocation philosophy would be international.
Yes.
So I know a lot of the big U.S. companies obviously do business globally, and vice versa. That's also true. The bigger international companies do a lot of business here. I mean, we're kind of seeing that happening.
Yes.
How do you incorporate that?
Well, again, because of the nature of these companies, they're usually global brands and they do business internationally. A lot of these companies have a focus on trying to grow, especially their emerging markets type business. Back in the 80s and early 90s, we saw a lot of the focus on these companies trying to invest more overseas. Like the mantra was, we want to have at least 65% of our earnings over in Europe. Well, that's now shifting, and they're saying, well, we want to have more and more earnings in the emerging markets area. So again, a lot of these companies, they have been there for many years, and they have the ability to work with the governments in these countries, and so we are getting exposure through that.
And is that your preferred way to get the international exposure, buying U.S. companies that do business overseas? What's your thinking on investing in companies headquartered outside the U.S.?
Yeah, I think it depends on the client and what their needs are and what their risk tolerance happens to be. For those clients who need to be very conservative and they are withdrawing money from their portfolios, I still believe that the U.S. tends to be a better place for them to be. For those clients who have a longer term time horizon and maybe have larger pockets of money to invest in, yes, we do go ahead than go into the specific ADRs of some of these multinational companies.
Right,
overseas.
and certainly with the emerging markets in particular, we know that over time they can return more.
Yes, absolutely.
But you got to have a cast iron stomach a lot of times to deal with some of those.
Yes.
Yeah. And so you talked a minute ago about the time horizon.
Yeah.
And I know a lot of the folks watching this maybe are approaching retirement, maybe in retirement. For a person who's kind of in maybe those very precarious years right now, what is some advice you could offer to them in terms of how they might consider their investments at this point?
Well, one of the things, again, as I mentioned, that these dividend-paying stocks, I believe, are a core portion of a portfolio for somebody who's in the area of about to broach retirement or currently in retirement. Again, because we've all talked about that longevity issue. We're all living longer. And owning stocks is probably one of the best ways to keep up with inflation, if not outperform inflation.
Yes.
So having at least a core portion of your portfolio in these dividend-paying stocks would be a good shift. We don't always find that in 401ks that there's the ability to look at these types of stocks.
It's very true. You often have limited choices.
Yes.
Yeah. So what's the role of fixed income in all of this?
Again, it's an individual basis kind of thing that we look at,
Right.
you know, where they are in their risk tolerances. We are in a period of very, very low interest rates, which has made it very, very difficult
Yes, it has.
to get any sort of a return other than appreciation in bonds.
Right.
But most people don't think about trading bonds. They think
true.
about buying them and holding them.
Yeah.
So if you just held the bonds after the financial crisis, you might have seen your bond portfolio rise in price. But if you weren't actively managing that and taking the profits from it,
Right.
you're just clipping the coupon on the bond. So, you know, making sure that you had a little bit more money in stocks, or, you know, as the bonds were going up, trying to put more money of that into the stocks would have helped. But now we're at the stage where the interest rates are starting to go up, which means that there's only one place for the bond prices to go, which is down.
Yes, and that's a whole other set of issues that could be down the road. But yeah, something to watch out for.
Exactly.
Well, Catherine, thank you so much.
Thank you,
so
Kate.
happy to have you join us today, and thanks everybody for watching. Appreciate it.
Great, thank you.